Hey guys, what is going on? Welcome into the video. So we had another wild week in the stock market, and this included a weekly range from over 6% from highs to lows on the S&P 500, including a single day with an over 5% swing. So in this video, we're going to be going over what we can expect next from the market, including catalysts and actionable trade ideas for the week and weeks ahead. Let's get into it. So first off, taking a look at what happened in the broad market last week, the SPY was range bound from 363 to 356 from Monday through Wednesday as everybody was waiting for the CPI data release to choose market direction. After tight consolidation, a large directional move will always come next, and that is exactly what came on Thursday. CPI data came in at 8.2%, which was 0.1% above the consensus estimate of 8.1%. Now this wasn't substantial, but it was enough to cause an initial sell reaction. The catch here though is pretty much everybody was expecting CPI to be ugly and were hedging their portfolios for this scenario. Institutional traders were in a record amount of put options, and there was a ton of shorting going on in anticipation for this event. For those who are unfamiliar how option hedges move the market, this chart lays it out nicely. So for example, when a trader buys a put option, there's a dealer on the other side that is selling that put to them. So when this happens, the dealer is then exposed to downside risk now that they have a short put position, so the dealer has to hedge this risk and protect themselves. The dealer then has to short an equal amount of stock to the put option, which is 100 shares per option contract, which then of course sends the underlying stock or equity lower. We saw the opposite of this happen on that Thursday drop-off from CPI. So because all of these institutions were in massive put positions and were all expecting the CPI release to drop the market, they took profits once the market opened to the downside. And this was pretty much a consensus trade. They expected the drop, they got the drop, so they took profits on their hedges. So once all these institutional traders took profits on their put positions by selling, the dealers were then forced to buy puts and to hedge those puts that they bought, and they had to buy an equal amount of underlying stock. So what did this action result in? It resulted in that massive 5% plus intraday bounce off of lows on that Thursday. And now that brings us to Friday. Because that massive move on Thursday wasn't because of positive news, it was more of just a de-risking and de-hedging event. We saw the opposite happen on Friday. It seems that a lot of traders re-entered their hedge positions that were covered on Thursday. The SPY rejected right at resistance, and this resulted in the sell back down. So now that brings us to this week and what to expect next. The SPY is now nearing back to the 356 core support level that was key all of last week. It was the bottom of the range from Monday through Wednesday and is that level that triggered the short squeeze up when it was reclaimed back above on Thursday. So this is the line of the sand for the week ahead in my opinion. As long as the SPY does hold above, buyers still have a shot to rally here, but if it breaks back below, then we see more downside to 354, 352.5, and then 349.12 to 350, which would trigger the next leg down if it does break below. Now, in order to have a real rally though, buyers need to fill this island gap up from about 369 to 373.15. The island gap is what triggered the start of this next leg down, and until it is reclaimed above, bears are still well in control of this trend, and we should expect bounces to continue to be sold back down until that gap is filled. If it is able to be filled, we could talk about seeing a rally upwards of 380 plus, but until then, this trend is guilty and proven innocent, and we should expect this market to continue to be in sell to bounce mode. One more key indicator for this trend is the 20-day exponential moving average, in which all recent bounces have been sold into when it is touched. If the SPY can reclaim and close above this spot, that could start a rally as well, but for now, this is key resistance until proven otherwise. Another behind-the-scenes indicator that is super important to the underlying market are the individual leading stocks and sectors. Some of those recent leaders we talked about are falling off a cliff. The two solar leaders in Enphase, ticker symbol ENPH, is now starting to look broken. First Solar, ticker symbol FSLR, is looking more like a short candidate than anything else, as it just closed below the 50-day moving average for the first time in months. And look out below if that 120 level breaks. Other leaders in Shockwave, ticker symbol SWAV, is looking ready to drop big if that 250 key support breaks. And Albemarle, ticker symbol ALB, broke its key trend line, and look out below if the 200-day moving average support breaks below on this one. To keep it simple, the stock market will not bottom if there are not individual growth stocks breaking out and holding their gains. A lack of individual stock leadership means a lack of institutional confidence that we are nearing a bottom. Mark Minervini, one of the greatest traders of all time, says that individual stocks breaking out and holding gains is his #1 indicator for overall market health and direction, which we are now seeing a major lack of. The #1 leading sector has switched now from the solar sector to now energy and oil and gas, which should give us even less confidence for this market, as this is obviously a big negative for inflation as well. And finally, we have not seen real capitulation selling yet, which is measured with the VIX in the high 40s to mid 50s. It has marked all historical market bottoms. We will likely need a final panic sell to bottom this market and are not there yet. We also have the next earnings season getting started this week with some big ones, including Netflix and Tesla. So taking a look at these charts, Tesla is breaking down from its head and shoulders pattern and now is below the key trendline support level. This is certainly a bearish pattern and sees more downside if it breaks below that 200 key support level, but it's also heavily oversold on the RSI indicator and more oversold than it was during the 2020 COVID lows. So I personally would not have any conviction to short here without a large relief bounce first, and that is what we may see this coming earnings, as it does seem like the stock is already priced for a sizable earnings miss. Netflix stock as well is looking primed for a large move, as it's been consolidating in the same range between 211 and 250 since August. This can be a great post-earnings trade setup depending on which direction it moves. It can be a play for shorts or put options on a break below 211, or a long play on a break and hold above 250. I would definitely lean on the short side more personally, as it recently broke below trendline support, in which it just backtested and rejected back off of that spot. If it breaks below 211, we could see those 200, 190, and then 175 levels as those next potential target spots down below. So that's it for the video, guys. Hope you enjoyed and hope I've provided some value to you. If so, make sure to hit that like button and subscribe button down below. It helps me out a lot, and I would greatly appreciate that. For anybody interested in joining the private Discord chat, that is the first link down below in the description to get my personal trade alerts. And I will catch you all next time. Thanks for watching. Peace out.